if you try to predict in advance or get attention in advance, it's becoming increasingly hard. And yeah, so that's what's happening today. We're no longer in the 1950s, and we can talk about the reasons why, but that's basically where we are.
Yeah, I mean that's super interesting, and it's very right. And why is that? Why is the world fragmented and almost inverted?
So to start with, we should basically ask, why was the world so normal in between 1950, let's say, to 1970? Because that period was unique in history, much more than our period is unique in many ways. The
Yeah,
world was always fragmented, unpredictable, governed by crowds and mobs and lunacy of various kinds. The world around 1950 was so stable and normal to the extent that it was because it was surrounded by a lot of really strong constraints. Government was very, very powerful, was at its peak. The industrial goods depended, the production process depended on the existence of a broad class of people that have the same education, the same skills, that come in and do the same thing at the factory or at the office. So basically the economy, or more broadly capitalism, needed the existence of a broad middle class because that's what the kind of governing production function, as dictated by the best technology of the time, demanded. Demographics were very different because you had a lot of young people that died, so there were fewer people. Labor was kind of a little bit more in command. And again, that lasted for a while and then didn't last anymore. The world as a whole had a clear kind of sheriff, one dominant country that kind of dictated how things worked. And everything that didn't work according to that order, we don't consider it to be part of the world. So it's not like the world was really stable in 1950. But the world we looked at was very, very small. And today we look all around and we understand that, everything is connected. And that's maybe the last point, that things were much less connected. There was much more friction. And Adam Newman couldn't show up and, within 5 years build an app that leases out tens of millions of square meters. The Kylie Jenner couldn't suddenly pop up and, compete with a large cosmetics company. There are hard constraints in place that basically made everything slower, more limited, and more manageable. And these things, with technology, with globalization, which is a factor of technology, and even with money itself becoming untethered from reality and enabling things to get funded really, really quickly, if they show any promise of generating some kind of return, basically drove things to become less and less grounded. Now, as we move into an economy that consumes much more services and much more content, that expands because more of the stuff that we consume is stuff that again is governed by nonlinear dynamics to begin with. The entertainment industry was nonlinear already 50 years ago, but it was a tiny part of the economy. Now everything we do is funneled through entertainment dynamics. I don't know why Brad Pitt is more successful than some other guy who is equally handsome, on paper has all the exact same kind of characteristics, same eye color, height, BMI, whatever. But the fact is that it is. And if I just put him into more movies, they're probably going to be successful. But even Brad Pitt doesn't sleep at night because he knows that the next movie might flop and he will not know why. So it's a world in which when you succeed, you have no idea why you succeeded, but you're never at peace even after you succeed. You're constantly stressed. And that's where we're headed. That privilege that Brad Pitt has is becoming the privilege of the rest of us.
And so when that translates to the real estate market, when you were writing the first book, you raised a point about you don't know whether Uber or General Motors is a quality tenant. And is that because of the wholesale changes going to the economy? I mean, we even talked about the media industry. If we just look back behind us, I mean, half the media industry just disappeared. Even the new media industry, when you were writing that article, the Kings of the Hill were Vice, and a whole bunch of these people, they're all gone. BuzzFeed is all gone. I mean, the destruction of businesses seems to be on a faster cycle.
Yep.
And those that are too big to fail, like General Motors, General Electric, all of these are on a slower cycle of obsolescence as well. Is that what you're thinking? And that's why the quality of tenant is not good enough anymore?
Yeah, I mean, if you look at a company like Uber, so one, it was private for a long time, even though it was already like $100 billion company employing, 20, 30,000 people. So it's a big tenant in the market, but I know much less about it than I used to know about a regular tenant of that size that would come to me and I have annual reports and it's all vetted. One. Second, even after it becomes public, it loses money. So I look at it and say, okay, this is a $100 billion company. It loses money. Is this a good tenant or a bad tenant? Would I rather have 50 small accounting firms use that space, or Uber, which is like, an S&P 500 company? It's very, very hard to tell. And again, you look at the General Motors on the other side, and you're like, okay, is that Lindy? Is it still here because it's Lindy, or it's here because it's like, it's about to disappear? So it's very hard to tell. What it basically told me is not that, offices will become empty necessarily, but that the way they are priced by financial markets is off kilter. That there's no way that these things are as stable as a government bond, that their cash flow should be capitalized at like 2.5% or 3%, as some office buildings are. What it also told me is that in order to continue to generate cash flow, they will probably have to become more similar to hotels or hospitality assets, meaning they have to convince people to come back every day or every month or every year, not just every 15 years. And they have to provide all sorts of services, which basically means both more CapEx and more OpEx in order to do that, which means that their cap rates should be higher and they should be evaluated more like an operating business, just like any other business on earth, rather than as a financial asset that is really a purely financial asset that, like, as I put it in the book, real estate was changing from a game of monopoly to a game of strategy. So, and the game of strategy, like chess, still means that every square you control has value in itself, but it also means that you constantly have to look around and figure out what everybody else is doing and respond. As opposed to the game of Monopoly, where you own a little square and everyone that walks by has to give you a check no matter what you do forever. So it's not that you can't make money, but that something fundamental has changed in the nature of the game.
Then COVID comes and a bigger picture emerges, which is a complete societal change in our relationship to cities because of technology. And then a further acceleration occurs as AI and robotics start hurtling in. So talk me through how you're thinking through that stage from the pandemic into what I refer to as the exponential age, because I don't think people are yet thinking through this fully. And every time I have conversations, people have half got into it. Everyone's having a half dinner party conversation. They're almost too scared to sit down and say, okay, what does it mean? And because it's an exponential, people just can't get their heads around it. So
Yeah,
let's
I
go
think
for it. There's a lot to unpack in all of that.
COVID showed us a few things that most of us still don't want to see and understand. So from the narrow aspect of real estate, the first thing it showed us that most people in the most kind of important office jobs can do their work remotely or from anywhere. The second thing it showed that many of these jobs probably don't need to exist at all, because once people don't have to be supervised and managed a certain way, and you start really measuring what they produce rather than, where they are or how they behave, then there's whole layers of management that don't need to be there. The management layers that do need to be there probably need completely different skills and abilities in order to manage those type of people. And it also showed us with companies like NVIDIA, for example, that embrace remote work and distributed work, that you can produce the most sophisticated physical goods, hardware, remotely and through remote collaboration. So it's not just about, uploading videos to TikTok or answering customer service calls, but that you can do basically whatever you want. Now, what I saw even before COVID is not just that this was possible, because there are some companies doing that even before COVID, but that this is necessary. And this comes back to that nonlinear economy thing. So if you remember, around 2015, Amazon decided that it's going to start looking for a second headquarters, right? HQ2, and then they chose actually 2 different locations. At the same time, when it's all around 2015, other companies like Apple and Facebook and Stripe started splitting their headquarters as well to 2, 3, 4, 5. Now, to the uncurious eye, this looked like business as usual. Companies always had, headquarters, like offices and branches all over the world. But what was different here is that these companies were not opening these offices in order to sell to the local market. They were opening these offices in order to hire from the local market. Basically, they were telling us, I'm splitting my core activities into 2 and 3 and 4, and my employees are now collaborating remotely, even though they're in an office, because a trade-off was emerging between the value of in-person work, which is indeed valuable, and the need to tap into the largest possible talent pool in order to make increasingly specific and specialized matches between people that have very, very unique skills and backgrounds and tasks that are increasingly specialized. So as the economy becomes more specialized, these matches become, the return on these matches becomes larger and larger. Now, this theory of matching is the same theory that economists use to explain why the internet actually made economic activity more concentrated initially, why superstar regions like New York and Silicon Valley became more important between 1995 and 2015. They said because the economy is more dependent on innovation and knowledge work and creativity, these people are flocking into the largest possible labor pools because that's where companies can make those matches. But what the theory didn't take into account is that however large Silicon Valley or New York are, if companies can suddenly hire from a pool of 100 million or 500 million people, and they do that, they have an advantage. And companies showed us even before COVID that they have a need to do that now, that things are so competitive and specialized that they have to hire from that type of pool, which is obvious if you look at, again, entertainment or sports. You know, the LA Lakers, they don't just hire people who live in LA. They hire people, they hire the best possible people from anywhere in the world. And when things become so competitive and so globalized, if you're unable to tap into the largest possible talent pool, you're falling behind. And again, and COVID started showing us that. But I feel like we're still stuck in a conversation where people see it as some kind of struggle between managers and employees, and the employees are lazy and they don't want to come back, or they're millennials, or they're Gen Z, or they don't have childcare, or whatever the reason.